Hello, Professor. My name is Alex Ramanam, and today I want to explain about the introduction to the normal inventory transactions. The inventory transactions are essential process within a business that involve in a buying and selling the management of goods or products held for the resale. These transactions play the crucial role in the maintaining accurate records of the company's inventory levels, ensuring smooth operations, and facilitating financial reporting. A normal inventory transaction encompasses a variety of activities that impact overall the inventory account and financial statement. Here we have the purchase transactions. In purchase transaction, we have the two type of transactions. First one is order placement, and second one is sales transactions. The order placement business initiate that involve that inventory process by placing the orders with the suppliers to replenish the stock. And in sales transaction, we want to discuss about the two things. Here we go for the sales order processing. When a customer places an order, the inventory is reserved to fulfill the customer request. That's called sales order processing. And inventory valuation means costing the methods and cost adjustments. The costing the methods means companies must decide on the costing method to the assigned cost to the inventory item, and the cost adjustment mean the periodic assignments or adjustment may be necessary to ensure the recorded value of the inventory align with the actual value. In my first in in my first slide, I want to explain about that. There is so many things to explain. That one is the stock transfer. In stock transfer, we have the three types of things is there. First one is interlocation transfer and the ownership transfer, and another one is the customer returns. And here we discuss about the introduction to the adjusting level inventory transactions. The reasons of adjustments have the three types. First one is the obsolescence, and second one is the damage or loss. Third one is the price change. In inventory reserve accounts, we have the two things, allowance of obsolescence and allowance for the damaged goods. And adjusting entries are two types, the general ledger adjustments and the cost adjustment. And the fourth one is the physical inventory counts. Here we have two types of this. First one is the periodic verification, and second one is the reconciliation. And fifth one is the financial statement impact. Here there is the two types. First one income statement and the balance sheet. And my second slide is explain about the inventory transactions of COGS. Inventory represents the goods a company hold for the resale. When these goods are sold, their cost is transferred from the balance sheet to the income statement as the cost of the goods sold. COG is the key factor determining the company's goods profit and ultimately its net income. And recording material cost. Material costs are significant component of COGS for the manufacturing and production companies. And here we have the general entries. Let us consider the scenario where the company purchases raw materials for the 5,000 bucks on credit. And general entry, we have the debit and credit. Debit, the raw material inventory is the 5,000 bucks, and the account payable, the credit is account payable is also like the $5,000. And here T account, so the T account is visually represent the changes in the accounts. Initially, the raw materials inventory T account will show on an increase at the debit side. The raw material inventory, the debit is the $5,000. As the material used in the production, they are transferred to the work in process inventory. The work in process inventory that we call WIP. The debit is $5,000 increases, the credit $5,000 decreases in the raw material inventory. When the finished goods are sold, the cost move from WIP to the finished good inventory. The finished good inventory means the here the debit 5,000 increases, the credit 5,000 decreases in the inventory. Finally, the goods are sold. Customers, the cost is recognized as the COGS. Here, the COGS, the debit 5,000 and the credit is also 5,000, increases the finished goods inventory and the visual representation. Including the visual representation of T accounts or arrows indicating the flows of cost through the raw materials inventory, then WIP inventory, finished goods inventory, and COGS. And my third slide, I explain about the adjusting entry impact on COGS and forecast. The first one is adjusting entry due to inventory count. The periodic inventory counts are essential to ensure the accurate financial reporting. And the second one is the adjusting journal entry to adjust the journal for the increased ending inventory, and adjusting the journal entry is made. In journal entry, we have the debit and credit. If the debit increases, the ending inventory and the credit cost goods sold decreases on COGS, and T accounts and COGS, and the fourth one is the impact on Parsi forecast. The adjustment effect on Parsi forecast by potentially increasing the net income. Lower COGS results in the higher gross profit, positively influencing the forecasted probability of the company. And my fourth slide is explained about strategies of the prevent forecasting errors. Here the here it's divided into five types. The implement regular inventory audits and the enhance the communication between the departments. The third one is utilize the advanced inventory management system, and the fourth one is the training and education for the staff. And fifth one is the implement of the continuous monitoring. And my fifth slide is about it's a conclusion. And accurately portraying in a company's financial success depends and accurately recording the inventory transaction, and the adjusting entry affects both COGS and the perceived projected financial performance by ensuring the financial accounts appropriately reflect the physical inventory count. These are the These are all the introduction to the normal inventory transactions from my side. Thank you, Professor.